Hey everyone, welcome back to the channel. Before we dive into today's eye-opening topic, make sure you hit that subscribe button and ring the notification bell so you never miss our content. Today, we're exploring one of the most fundamental yet misunderstood aspects of modern economics, why the global economy depends on debt. We often hear that debt is bad, that countries and people are borrowing too much, yet the entire economic system seems to require ever-increasing debt to function. Without constant debt growth, economies collapse into recession. This seems paradoxical. How can an economy be healthy while depending on something we're told is dangerous? Drop a comment below telling me what you think about debt. Is it a necessary tool or a ticking time bomb? Now let's unravel why debt isn't just common in our economy, but absolutely essential to how the modern financial system operates. To understand why the economy depends on debt, we must grasp a shocking truth. Most money is created through debt. When banks make loans, they don't lend out existing deposits, they create new money. This means our money supply itself depends on debt creation, making debt fundamental to the system rather than optional. When you take out a $100,000 mortgage, the bank doesn't take $100,000 from their vault and give it to you. Instead, they simply credit your account with $100,000 that didn't exist before. This is new money created by the act of lending. Your debt to the bank created money that now circulates in the economy. Approximately 95% of money exists as bank deposits created through loans, rather than physical cash printed by central banks. This means almost all money in circulation exists because someone, somewhere, borrowed it into existence. Without borrowing, the money supply would shrink dramatically, making economic activity nearly impossible. When loans are repaid, money is destroyed. If you pay back your $100,000 mortgage, that $100,000 disappears from the money supply. For the money supply to remain stable, new loans must constantly replace paid-off ones. For the money supply to grow, which economies need to accommodate population and productivity growth, total debt must increase. This creates an inherent dependence on debt growth. If everyone simultaneously tried to pay off debt without new borrowing, the money supply would collapse, triggering severe depression. This isn't theoretical. It's what happened during the Great Depression when bank failures and debt defaults shrank the money supply by over 30%. Central banks control the monetary base, physical currency plus bank reserves, but commercial banks create the vast majority of money through lending. This means money creation happens in the private sector through profit-motivated lending decisions, not just through government policy. Banks lend when they see profitable opportunities, expanding the money supply. They pull back during crises, contracting money supply. The fractional reserve banking system amplifies debt's role in money creation. Banks keep only a fraction of deposits as reserves and lend the rest, which gets deposited elsewhere and lent again. This multiplier effect means a small amount of central bank money becomes a much larger amount of commercial bank money through successive lending. Understanding debt-based money creation reveals why debt reduction can paradoxically harm the economy. When households and businesses simultaneously try to reduce debt, called deleveraging, they destroy money faster than new money is created. This debt deflation causes economic contraction, rising unemployment, and can spiral into depression without intervention. Central banks and governments must ensure adequate debt creation to maintain money supply growth. When private sector borrowing collapses during recessions, governments typically borrow more to compensate, running deficits to inject money into the economy. This isn't fiscal irresponsibility. It's essential to prevent money supply collapse when private debt creation stops.
Beyond money creation, debt finances the investments that drive economic growth. Businesses borrow to build factories, develop products, and expand operations. Governments borrow to build infrastructure. Consumers borrow to buy homes and cars. Without this debt-financed investment, economic growth would stagnate. Business investment drives productivity and growth. When a company borrows to buy new equipment, that equipment increases productive capacity. When they borrow for research and development, they create innovations that generate future profits. This debt-financed investment is how economies grow beyond simple population increases. Very few businesses could grow using only retained earnings. A startup with a great idea but no profits needs debt or equity financing to develop the product. An established company wanting to expand into new markets needs capital before revenue materializes. Debt allows businesses to invest in their future rather than waiting years to accumulate profits. Infrastructure investment is overwhelmingly debt-financed. Governments borrow to build roads, bridges, railways, airports, and utilities. These projects cost billions up front, but generate benefits over decades. Debt financing allows the costs to be spread across the years when benefits are realized, matching payments to benefits received. Consumer debt finances major purchases that individuals couldn't otherwise afford. Few people could buy homes without mortgages, requiring 30 years of saving before purchasing. Mortgages allow people to buy homes while young, building equity over time. Auto loans, student loans, and other consumer debt similarly allow immediate consumption of goods and services that would otherwise require years of saving. The time value of money makes debt economically rational. A dollar today is worth more than a dollar in the future because it can be invested to generate returns. If you can borrow at 5% to invest in something returning 10%, borrowing makes economic sense. This spread between borrowing costs and investment returns drives debt-financed growth. Economic cycles are partly driven by debt cycles. During expansions, optimism and profitable opportunities encourage borrowing and investment. This debt-financed investment accelerates growth. During contractions, pessimism and losses discourage borrowing. Reduced debt creation slows investment and growth, creating recessions. The paradox of thrift illustrates debt's importance. If everyone tries to save more simultaneously by spending less and avoiding debt, total spending falls, causing a recession. Businesses see reduced revenue and cut investment. The economy shrinks. Individual attempts to be prudent create collective harm. Some level of debt and consumption is necessary for economic health. Emerging economies particularly depend on debt to finance rapid development. Building modern infrastructure, factories, and cities requires enormous upfront capital. Countries like China borrowed heavily, both domestically and internationally, to finance the investment that transformed them from poor to middle income. Without this debt-financed investment, development would take generations longer. Understanding investment's dependence on debt explains why credit availability is crucial to growth. When banks lend freely, businesses invest and economies grow. When credit tightens, investment collapses and recessions follow. The 2008 financial crisis saw credit markets freeze, causing the deepest recession since the Depression because businesses couldn't borrow to invest.
Government debt plays a unique and essential role in modern economies. Unlike household or business debt, government debt serves crucial macroeconomic functions that make it fundamentally different and, in many ways, necessary for economic stability. Government bonds are the foundation of safe asset supply. The global financial system needs safe, liquid assets for banks to hold as reserves, for pension funds to match liabilities, and for investors to preserve capital. U.S. Treasury bonds, German Bunds, and other government bonds fill this role. Without government debt, these safe assets wouldn't exist in sufficient quantity. The safe asset shortage is a real economic problem. As wealth grows globally, demand for safe assets increases. If governments don't issue enough debt, this shortage can cause financial instability as investors chase safety in inappropriate places, creating bubbles. Government debt provides the safe assets the system requires. Counter-cyclical fiscal policy requires government debt. During recessions, private sector income falls and spending collapses. Governments can borrow and spend to replace this lost demand, preventing deeper recessions. This stabilization function is impossible without the ability to run deficits and issue debt during downturns. The COVID-19 pandemic demonstrated this dramatically. Governments worldwide borrowed trillions to support lockdown economies, preventing a depression far worse than what occurred. Without this debt-financed spending, economic catastrophe would have followed. This wasn't reckless borrowing, it was essential crisis response. Modern monetary theory argues that governments issuing their own currency can never involuntarily default on debt in that currency. They can always create money to pay debts. The real constraint isn't financial, but inflation. Governments can borrow and spend until inflation becomes problematic, not when debt reaches arbitrary ratios. Debt sustainability depends on growth and interest rates. If a government can borrow at 2% and economic growth is 3%, debt to GDP ratios can remain stable even with continuous deficits. The U.S., Japan, and many countries have sustained high debt levels for decades without crisis because growth and low rates make the debt manageable. Government debt creates private sector assets. When a government issues bonds, it creates an asset for whoever buys them. Government deficits equal private sector surpluses by accounting identity. Government borrowing puts money into the private sector, increasing private wealth. The obsession with government debt often ignores this mirror image of private assets. Infrastructure investment justifies government borrowing.
If debt finances productive infrastructure generating future economic benefits, the investment pays for itself through increased growth. This is like a business borrowing to expand. The debt is matched by assets and future revenue increases. Intergenerational considerations make some debt reasonable. If current infrastructure or education benefit future generations, it's fair for those generations to help pay through inheriting the debt alongside the benefits. Not all government debt represents burden on the future. Much creates valuable assets. Understanding government debt's role reveals why debt reduction isn't always desirable. If the private sector is deleveraging and the government also reduces debt, total spending collapses, causing severe recession. Sometimes increasing government debt is economically necessary to offset private sector deleveraging.
Debt doesn't just exist within countries. International debt connects the global economy and enables crucial capital flows that allow development and trade. Cross-border debt makes the world economy function, but also creates vulnerabilities and dependencies. Trade deficits require capital inflows, which typically take the form of debt. When a country imports more than it exports, it must attract foreign capital to finance the deficit. This capital often comes through foreigners buying government bonds or corporate debt. The U.S. runs persistent trade deficits financed by foreign purchases of U.S. debt instruments. Emerging markets depend on international borrowing for development. Most developing countries don't generate sufficient domestic savings to finance rapid development. They borrow from international markets, selling bonds to foreign investors or borrowing from institutions like the World Bank to finance infrastructure and industrial development. Dollar-denominated debt creates global dollar dependence. Companies and governments worldwide borrow in dollars because of lower rates and deeper markets. This creates structural dollar demand regardless of U.S. economic conditions. An estimated $15 to $20 trillion in dollar debt exists outside the U.S., making the global economy dependent on dollar liquidity. Currency mismatches create vulnerabilities. When countries borrow in foreign currency but earn revenue in domestic currency, exchange rate movements create problems. If the domestic currency weakens, the debt burden in local currency terms increases, potentially becoming unpayable. This has triggered numerous emerging market crises. Capital flight during crises shows international debt's dark side. When investors lose confidence in an emerging market, they pull capital out, forcing the country to sell reserves and raise interest rates to defend the currency. This often creates severe recessions. International debt that seemed beneficial during good times becomes crushing during crises. The IMF and World Bank serve as international lenders of last resort. When countries face debt crises, these institutions provide emergency lending, though usually with strict conditions requiring economic reforms. This system prevents complete financial collapse, but creates dependence and sovereignty concerns. Debt traps can ensnare developing countries. If countries borrow for unproductive purposes or face bad luck, they can enter spirals where they borrow to pay previous debts, with debt growing faster than their economy. Several African and Latin American countries have experienced this, requiring debt forgiveness to escape. China's Belt and Road lending has created new international debt dynamics. China has lent hundreds of billions to developing countries for infrastructure. Some analysts worry this creates debt dependency, though supporters argue it finances needed development that Western institutions wouldn't fund. Understanding international debt reveals why global cooperation on debt is necessary. Countries are interconnected through debt relationships. A default in one country can trigger contagion, affecting lenders and creating broader financial stress. International debt makes the global economy more integrated, but also more vulnerable to shocks. Debt doesn't just grow steadily. It moves in cycles that profoundly affect economic stability. Understanding these debt cycles reveals patterns that drive booms, busts, and financial crises. We may be in a long-term debt supercycle with important implications. The Minsky cycle describes how debt drives financial instability. During good times, borrowers and lenders become optimistic, taking on riskier debt. This speculative and eventually Ponzi financing creates fragility. When the cycle turns, over-leveraged borrowers default, triggering crises. This cycle has repeated throughout history. Global debt has grown dramatically, reaching over $300 trillion, or roughly 350% of global GDP. This includes government, corporate, and household debt.
Debt has grown faster than GDP for decades, raising questions about sustainability. Each crisis is resolved by adding more debt at lower rates. Eventually, this may become unsustainable, forcing a major deleveraging with severe economic consequences. Others argue technology and productivity growth will allow continued debt growth. Understanding debt cycles helps explain why financial crises occur despite seeming prosperity. Debt accumulation creates fragility invisible until something triggers a turn. The longer expansion continues, the more debt accumulates and the greater the potential crash. Debt deflation is the most dangerous economic dynamic. When debt levels become excessive and borrowers must deleverage, they sell assets and reduce spending to pay debt. This crashes asset prices, making debt burdens worse relative to asset values. More selling follows in a vicious spiral. The Great Depression exemplified this. Central banks have become lenders of last resort and buyers of last resort to prevent debt deflation. When debt markets freeze, central banks buy assets to restore liquidity and prevent spirals. The 2008 crisis and 2020 pandemic saw massive central bank interventions to stabilize debt markets. The zero lower bound constrains central banks' ability to fight debt-driven crises. Interest rates can't go much below zero, limiting how much monetary policy can stimulate. This has led to unconventional policies like quantitative easing and negative rates, but effectiveness is debated. Some economists argue we're in a debt supercycle begun in the 1980s that will eventually end badly. Each crisis is resolved by adding more debt at lower rates. Eventually, this may become unsustainable, forcing a major deleveraging with severe economic consequences. Others argue technology and productivity growth will allow continued debt growth. Understanding debt cycles helps explain why financial crises occur despite seeming prosperity. Debt accumulation creates fragility invisible until something triggers a turn. The longer expansion continues, the more debt accumulates and the greater the potential crash.
Understanding that the economy depends on debt has practical implications for individuals, investors, and policymakers. Accepting this reality allows better navigation of the financial system rather than fighting against its fundamental structure. Personal debt can be tool or trap depending on use. Debt financing education that increases earning power or a home that provides housing while building equity can be economically rational. Debt for consumption that doesn't generate future benefits is riskier. Understanding this distinction allows smart debt use. Investors must understand debt cycles to protect wealth. Late in credit expansions, when debt levels are high and lending standards loose, reducing risk makes sense. Early in cycles, after deleveraging, when debt is low, taking risk is rewarded. Reading credit conditions helps time investment decisions. Policymakers face difficult trade-offs. Allowing excessive debt accumulation creates crisis risk, but restricting credit severely limits growth. Finding appropriate balance is challenging. Post-2008 regulations tried to limit excessive risk-taking while maintaining credit availability, but debates continue about whether the balance is right. Financial literacy should include understanding money creation through debt. Most people don't realize that money is created through lending. This knowledge changes how you view debt, money supply, and monetary policy. It reveals why credit availability is so economically important. The moral dimension of debt has changed. Traditional views saw debt as shameful or dangerous. Modern economics recognizes debt as essential to growth and prosperity when used appropriately. This doesn't mean all debt is good, but it means blanket condemnation of debt is economically naive. Demographics affect debt sustainability. Aging populations in developed countries will strain government debt as pension and healthcare costs rise. Younger populations in developing countries provide demographic dividend that can support debt-financed development. Population trends strongly influence debt trajectories. Ultimately, we must accept that our economy depends on debt, not because of moral failure, but because of how the system is structured. Money creation, investment financing, and economic growth all require debt. Fighting this reality is futile. Understanding and working within it is pragmatic. We've explored why the global economy depends on debt from multiple angles. Debt creates the money supply itself. Without borrowing, money doesn't exist. Economic growth requires debt-financed investment in businesses, infrastructure, and human capital. Government debt provides essential safe assets and enables counter-cyclical policy. International debt facilitates global capital flows and development. Debt cycles drive financial instability, but also growth.
This isn't a moral judgment about whether debt is good or bad. It's a recognition of how the modern monetary and economic system actually works. Debt is woven into the fabric of the economy so deeply that calling for its elimination is calling for a system collapse. Understanding this reality helps you navigate the financial world. It explains why central banks and governments work so hard to maintain credit flow during crises. It reveals why debt reduction can hurt the economy. It shows why debt grows over time in absolute terms, even though debt to GDP ratios can be stable or falling. The challenge isn't eliminating debt, but managing it wisely, ensuring it finances productive uses, preventing excessive accumulation that creates fragility, and maintaining ability to service debt through growth. This balance is difficult but essential. Now, I want to hear from you. Does understanding debt's role in the economy change how you view personal or government debt? Do you think current debt levels are sustainable? Are we headed for a debt crisis, or can this continue indefinitely? Share your thoughts in the comments below. If you found this explanation valuable, please give this video a thumbs up and share it with anyone trying to understand how modern economies really work. Make sure you're subscribed with notifications on so you never miss our deep dives into economics and finance. Thank you so much for watching, and I'll see you in the next video.